What if I told you an account could win 57.41% of the time across 1,621 trades and still lose $21,162.73? That is exactly why win rate is one of the least useful numbers if you do not also look at size, payoff, and behavior. This was a personal Zauzd account on MT5. It was heavily concentrated, with 98.52% of records in gold. Gross profit was $60,248.45, gross loss was $81,411.18, and profit factor was only 0.74. So yes, the account was often right. It just was not paid enough when right, and paid too much when wrong. The path matters too. The worst closed record drawdown was minus $21,664.86, almost the same as the final net loss. Recovery from that worst point took 365.38 days. That tells you this was not one bad week. It was a long failure of process. The monthly record was unstable. There was a small gain in May 2025, then repeated losses, a brief improvement in November and January, then a severe deterioration in April 2026 and another large loss in June 2026. The pattern is familiar, temporary improvement, then the same weaknesses reasserting themselves. Activity made things worse, not better. Lower activity days were close to flat at negative $110.45 across 78 days. Higher activity days lost $21,052.28 across 75 days. The median trades per active day was 8, but once activity reached 18 trades or more, expectancy turned negative. More engagement did not create more edge. It created more damage. The hourly and weekday breakdowns reinforced that this was a fragile process. Hour 12 was positive at $2,233.01, Hour 20 made $589.79, but Hour 15 lost $11,149.95. Wednesday was positive at $1,907.80, while Tuesday and Friday were the weakest days. That is what an unstable edge looks like. It works in pockets, then gives it back elsewhere. Size was another problem. The largest volume quartile averaged negative $106.60 per trade, compared with negative $1.27 in the smallest volume quartile. Bigger size did not improve quality. It magnified mistakes. There were also 71 loss following size escalations, which is exactly the kind of behavior that turns a normal drawdown into something much harder to recover from. Re-entry behavior was aggressive. There were 446 rapid post-loss re-entries and 533 rapid post-win re-entries. Rapid loss re-entries with size increase produced $7,507.31 of net loss impact, and the loss-chasing signature was negative $5,797.33. In plain English, the account kept treating an exit as a signal to act again, instead of a signal to slow down and review. The median winner lasted 0.02 hours and the median loser 0.03 hours. That means the account was turning over risk very quickly in a noisy market. It was not giving ideas time to develop. It was just cycling exposure. So the lesson is not that frequency is bad. The lesson is that frequency without selectivity becomes a cost center. If one market dominates the account, then process quality has to be much tighter. If size expands into weak conditions, results deteriorate. If you re-enter immediately after losses, you usually compound the problem. A better framework would have been simple. Limit same direction stacking unless it is tested. Reduce size when the market is not behaving as expected. Add a mandatory pause after a loss sequence. Use a regime filter so you are not forced to trade every hour just because the market is open. And track expectancy by size bucket, not just overall win rate. The reflection from the trader was honest. Real money learning started after demo testing, trade frequency increased, size increased with confidence, losses became harder to contain, and emotional trading made the drawdown worse. That sequence is important. Account failure usually arrives through cumulative decisions, not one dramatic mistake. The real takeaway is simple. A good trading journal should ask not only whether a trade won, but whether it should have been taken, whether the size was justified, whether the regime was suitable, and whether the next trade was a response or a reaction. That is how survival is protected. And in trading, survival comes before anything else.